Why, in your opinion, are Irish investors so focused on property? Is it just because there aren't other options there, or is there something more kind of long-term behind it?
The key to property investment, the one single reason why it's so attractive is because it's hardly ever valued.
Yeah.
It's not valued.
Like private equity investments.
Yeah, it's not valued every 5 minutes, and you can't go onto your phone and check the current value of your apartment in Clongriffin or whatever.
Yeah.
It gets valued every time something sells on the property price register, so maybe a couple of times a year, and so there's no volatility or very little. And and in the meantime, you have this lovely rent coming in every month, and you can drive by it and have a look at it and see it's still there. So
It's tangible, yeah.
In theory, it seems really attractive because it doesn't jump around the way equities do, and you get a lovely income. In practice, it's completely different to that, of course.
Hi everyone, and welcome to another episode of Stock Club. Today I'm joined by Dave Quinn. He's the managing director of Investwise, a financial planning company based here in Ireland. He has over 20 years of experience in financial planning, working for companies like Dutch International as an international equity administration manager, as well as JP Morgan as a hedge fund account manager. He holds a master's in finance from UCD, as well as one of the first independent certified financial planner professionals in Ireland as well. I hope I got that right, David. Did I?
Perfect, Mike.
Yeah, just a bit of a mouthful. So one of the premier international qualifications for financial advice and plannings. Dave is also a founding member of the Society of Financial Planners in Ireland as well. Dave, welcome to Stock Club. You've got a lot of mouthfuls there to get over in terms of titles, but fair play to you.
Thanks, Mike. Delighted to be on the show. Yeah, I'm never studying again as long as I live. I've done enough.
Yeah,
to last a lifetime.
At the end of the LinkedIn name, and you have to do all the little acronyms, one after the other.
And no one ever, in all my years working, no one's ever asked me to describe or list out my qualifications. So you wonder why I did all that work.
Sounds good. It sounds good on a podcast intro, anyways. But,
yeah.
Instead of me butchering all your titles, could you just give us a little more about your background, about yourself, and how you ended up at Investwise?
Yeah, so I did a business degree in DCU in the early 90s, and specialized in investments and financial markets during that 4-year degree. So I had an interest in the area. And in the late 90s, when I graduated in 1996, and the late 90s in Dublin was a real boom time in that particular space. The IFSC was just kicking off. A lot of the fund houses were moving to Dublin and setting up operations here. So there was lots of work for anyone who wanted to work in the IFSC in the investment game, and that suited me perfectly. I was interested in it, and had specialized in it with my thesis and my work in DCU. So I did all of interview rounds with Citibank and Deutsche Bank and the big new IFSC operations, and ended up with Deutsche Bank under Paul McNaughton. And a lot of that team actually have gone on to set up Cairn, which is a big Irish-owned fund admin house around Europe now as well. But did my formative years in there. Were initially working on Korean equity funds before that crash in the late 90s, and then moved on to tech funds, whatever was the popular fund at the time. Typically, we were working on.
So you went from Korean stocks crashing to the dot-com bubble, one after the other. Is that correct?
Yeah. It's just
nice
my career is
a
series of stock market crashes, and the LTCM crisis and all those late 90s problems, and learned a lot from those. And I was just working in back and middle office for these funds. I wasn't trading or picking stocks or anything, but it was a very, very formative 7 or 8 years. And then I left that and went to a startup, which actually started up in Malahide Marina Village, believe it or not, called Trainaut, which was a hedge fund operation, which was eventually bought out by JP Morgan, and did a few years with them, which was brilliant. So in the Deutsche Bank era, I kind of learned a lot about the investment markets and derivatives and, equity volatility. And then in that hedge fund startup, I learned a lot about a startup, small business, and, working with the founder a lot, and, how to scale a small business in that space as well. That was bought by JP Morgan, and I got a bit tired of the long hours and decided I wanted to career change. So I left there on St. Patrick's Day 2004. I remember it very clearly because I left the office at 1:45 in the morning and went straight to Tamango's for a St. Patrick's Day drink and sat at the bar on my own and said, that's enough. I need to get out of this game. And left that following day and took a little career break. Actually, used to do a lot of sailing, and I took a career break and worked with the Irish Sailing Association for about 18 months at that time, which was a brilliant break. Lucky enough to work over at the Olympics in Athens and a few other cool things, and decided at that time that I didn't want to work in my hobby. But I had met an awful lot of great contacts during that time and decided I'd try and set up my own business. So that was late 2005, early 2006. Then I set up Investwise. Investwise was actually a very small financial advice business linked to an accountancy practice, FMB, but they were only just doing their own pensions and a few small transactions. So I took it over and rebranded it and started from there in 2006 with nothing really, no client, very few clients, but a clean philosophy. And thankfully, because it was 2006, we didn't have a lot of legacy leveraged property funds or any kind of crazy stuff that some financial advisors would have had. And it wasn't a bad time to start with a clean slate. And also we had very much a philosophy of investing in index funds and global diversification and low cost, which was the total opposite of what was popular at the time. I was getting pitched everything from leveraged marina investments in Cape Cod to Bulgarian property and, everything in between.
The Bulgarian property always gets bringing up. Anytime we talk Celtic Tiger, it's always the Bulgarian apartment blocks.
Because there was festivals.
Harbinger of doom almost.
I think the marina in Cape Cod was even worse, to be honest. Investing in the marina, people did it though, and there was lunches in the Shelburne Hotel with these promoters promoting these things, so it was hard to avoid it. And we avoid commissions on investment products, so we don't tend to get sucked into a lot of these syndicated specialist investments anyway. So that's how I got started.
So that's what I wanted to ask you about. You mentioned Investwise philosophy, and you don't take commissions. You don't work with commission products. So what is it that Investwise does that is so different from other financial planners out there?
Yeah, that's a brilliant question, and something I struggle with every day because it's very hard in the financial advice space to distinguish yourself. Everyone seems to say the same things, and but I guess in our case, our USP, or where we get passionate about our client dealings, is that we start with a financial plan. We don't start with a product, and also we don't have to sell a product to earn anything. We just charge a fee to our clients and we put together a financial plan. So we tend to attract a lot of business owners and people in their 40s because they are established in their careers and they maybe started to accumulate some wealth, but they have complicated affairs with their business, their savings, maybe some inheritance questions, and they come to us for some independent guidance without the pressure of a product sale. So we will charge a fixed fee and we will map out their current situation and their kind of we have some sophisticated projection tools. So we'll project out what their lives would look like over the next 20 years, 30 years, including exiting a business or passing on money to kids or, retirement plans and investment strategies they might have. Pull all that together into a plan and give our guidance on where we think they might be making mistakes or where we think they're on track, but just to continue, where they might save some tax, and give them guidance on what most people come to us looking for is a bit of peace of mind that they're doing the right thing and they're not missing a trick most of the time. So we'll give them reassurance that maybe they are missing a trick with a holding company or with some inheritance or gifting or there'll be something that we'll identify, and they'll go away from that 2 or 3 week process with a set plan mapping out the next 20 years, which is always wrong, but it's a good foundation for future decisions that they make. Not once in that process do we mention a product or try and sell them a pension or some life assurance or an investment plan.
Yeah.
This process
or a floor of a Bulgarian apartment block.
yeah, correct. Yeah. they're free to go and do their own thing if they want at that stage, with some very good guidance on what we think they should be doing. The vast majority of people will then trust us to help them on an ongoing basis on a retainer to keep to give them some ongoing guidance with all those various issues, because life gets in the way and things change constantly. So typically we'll agree a retainer then every year to be their eyes and ears and sit on their side of the table when they're discussing their portfolios, and we'll manage those products for them as well, but we don't earn any commissions on selling them. So that gives us great freedom to, use the best global index fund providers. So like Vanguard, for example, we would have a lot of our portfolios with Vanguard, which is rare for an Irish advisor to recommend Vanguard because they don't care and they don't pay
Yeah.
or promote themselves, and they don't pay us anything to advise. So you don't see them a lot in portfolios. But as a baseline, that can work quite well, and we're free to do that. And it's lovely to have that freedom that we can kind of do what we want. We're not tied to anyone who might be paying us. So
Yeah.
it gives us great freedom.
It's kind of exposing that you've set yourself up in a way that goes without commissions, and you immediately flock to the kind of cheapest provider of ETFs and index funds out there.
Yeah.
And it kind of begs the question, why is that not the automatic place to go? Do you know, it kind of muddies the waters a bit of why other people aren't doing that.
Yeah, I'd say 95% of financial advisors don't recommend ETFs and Vanguard and the likes because they can't get paid. And that might work fine if the customer is aware of that. But, I've just felt that's what I do. And that's what I would want to see. And I can sleep at night knowing that we're remunerated and set up in the way that guarantees that we're acting in the client's best interest. Every other model has some conflict somewhere.
Yeah, absolutely.
But very few do it because it's not that lucrative.
Okay, I'm going to throw a very broad question at you, but I don't feel too bad because you seem well able for it. So talk to me about the investing landscape in Ireland as a whole.
Yeah.
Do you think it favors the average investor or the retail investor, the person who's putting money aside, a couple of hundred, maybe up to $1,000 out of their salary once a month?
It's getting better, but I when I get asked this, I always say that Ireland as a population, maybe this is a little condescending, but we're a little bit like teenagers in that we have one generation of people who have some money now, and we're learning how to deal with that, and still making mistakes. We had our first big lesson in 2008, 2009. That's quite a long time ago now, but I don't think a lot of Irish investors really got the full lesson of what happened in that period, and how you should be investing. We don't have generations of education in how to manage money, how to save, where to invest, what the stock market can do. So we tend to, you can see it by the amount of money that's on deposit in the Irish banks, 150 plus billion. We're still new to investing, so we're very comfortable with property and cash, and we're not comfortable with anything else. Now, that's not helped by a few structural problems. The tax on ETFs is penal and complicated, and
it's completely prohibitive for the average investor, I believe. And I know you deal with clients who can, especially business directors, they can have their own kind of self-directed pensions, which in some form kind of falls into that, like ISA or IRA product of a type, which isn't accessible to the average investor. But in general, I think, and we've talked about this at length on the show at this point, how prohibitive it is and how much it's removing passive investing as an option for a lot of investors, unless they get into a pension and give up a lot of control and add fees and all the rest.
Yeah, I don't think it's as bad as people make it out, to be honest. It depends on what type of stock you invest in, because if you're invested in a high dividend paying equity portfolio, the 41% rate is a blend of your income tax rate and your CGT. It's the 8-year rule that does the damage more than the rate, I find, in my own view, and I think that's going to go now in the budget changes. But we get to that. But So you have that tax rate is an impediment to proper investing. You have very, very high fees with the traditional providers, the banks and the insurance companies, which is another disincentive. And also because they pay commissions to advisors, there's lock-in periods of up to 5 years, 5 or 6 years. So you start doing your €1,000 a month into an index equity fund, you can't get the money back out for 6 years. It's illiquid. That's a huge problem for people, especially younger people who might need the money for a house deposit or college fees or whatever. So
Yeah.
that those, and then our education system doesn't educate people that the stock market is a great wealth generator if you're disciplined and behaved and you do the right things. It's a magnificent way to create wealth. But all we think of is our parents losing everything on bank shares or something like that. I get that
Yeah.
every time someone comes into me. One of the first questions we actually ask people when they come in our door and start the planning process is to tell us about their parents, because we learn a lot of our financial behavior from our parents. And our parents had, well, I don't know what age you are, Mike. I'm 51, but our parents had defined benefit pensions, so they were sorted for their retirement, and they had only really started to generate some wealth, and a lot of that might have been stock options in the banks, and they got destroyed. So that's the first experience the Irish middle class had of wealth generation was bank shares and aircom shares
I
and
was
that
going to
kind of
bring
thing.
up Aircom because
Yeah,
that almost precedes it. It was
yeah,
a state sponsored pump and dump nearly.
that's right. So it was an absolutely disastrous first experience in the stock market,
Yeah.
and index funds were just alien, or a properly diversified portfolio of any description was just alien to people here. So we're only starting to learn that now. And I was in London last weekend, and the tube was just absolutely covered in cheap online trading platforms,
Yeah.
and that's a very democratic and exciting way for people to start their journey on investing. But the scale isn't here in Ireland yet for that to be adopted across the board. It's still very much a niche, and people still go down to their bank mostly and say, "I want to save 500 quid a month. Where should I go?" And it goes into Irish Life multi-asset portfolio 3 or something.
Yeah, I think you're right in the education part of it, because you see investing cultures in the US especially, but up
Yeah,
in the Nordics as well, in Sweden, and like Sweden is kind of the only successful IPO market in Europe at the minute, because and companies are flocking from other European countries to go there because there's investors there, there's liquidity there, and there's actual like chance of success, we'll say, for a new
mm,
company coming onto the market.
yeah,
And they've built structures around products for investors, for the average investor. We mentioned the lack of, well, there's a litany of like kind of issues we can discuss, and a lack of accessibility in Ireland. You mentioned the deemed disposal rule every 8 years, essentially ruining any chance of compounding for passive
yeah,
investors. There's the extortionate 41% is extortionate in my eyes, exit tax on those as well. There's a lack of any kind of ISA like or IRA like product of a self-managed tax efficient way of investing. Do you foresee, and we've seen some kind of green shoots here
mm,
with budget 2026, Pascal O'Donoghue has basically said we're looking at improving the average investor's experience in Ireland.
yeah.
What are your hopes for budget 2026? What do you see coming in, and is this kind of like opening the floodgates? Will it become a more investable place for the people out there, and investing becoming less of a taboo subject, I suppose?
Yeah, so if we look at the two big pressing issues, one being the tax rate and the other being the potential for an ISA type product. The ISA one is like they've done it before. We had our SSIA, and that was hugely successful at a time, when we were in a similar growth trajectory and a lot of cash, and the government were trying to encourage people to save. So it wouldn't surprise me if they relaunched that. That was, it was limited in how much you could put into it and what you could do with it, but it was a very successful program. So I haven't heard any specifics, but I know it's being discussed, and everyone would support that. The only problem with that is it does conflict slightly with the government's plans to roll out wider pension coverage, and I think that would be worry from the legislator's point of view is does it muddy the waters a bit with auto enrollment coming in September. That would be my concern as to whether that one gets launched or not. But I think it will happen eventually. And on the rate, I'm really skeptical about the rate changing a lot. But talking to insurance company insiders, they're convinced they're going to change all three elements. So the rate coming down to 33%, the deemed disposal rule, 8-year rule going completely, and offsettable gains and losses.
Yeah.
Insiders are convinced all three are going to happen. Logistically, that'd be very difficult to manage, because do they cut off? When do they do the cut off? Do they do it at the end of next year where it's 41% up to December? Or do they, if you haven't had your 8-year, are you now free to just use the CGT rate from inception? Can you offset gains and losses previously held on funds? It's much more complicated than people are making out. And if you have ETFs in a platform or with Revolut or someone versus an insurance company product, how will that work? So I think there's quite a lot to be worked out, and that's why it's been slow. But insiders seem to think all three are going to happen, which would be amazing for Irish investors.
Yeah. And how would you think that would affect even your own business? Do you think that would bring in new investors, or I feel like the desire is there for a very small cohort who are waiting for this, but the goal is really to make this a widespread adoption of kind of passive, easy to do investing, like as in Ireland isn't really set up for, there's a niche there, and MyWallSt is like kind of really looking at that niche of stock pickers, but that's a very small subset of the overall population. You know what I mean? How would these products bring in that overall population?
Like as I said, the SSIA product was hugely successful. Now that had a little government incentive at the start of it, but it was still adopted widely. I think for there to be mass adoption on savings products, it needs to be something that's kind of government sponsored. People don't trust. People are very wary of trusting. So if it seems like it's a government promoted product.
And the sad thing is here, the government is the one not to be trusted. If you look back at the history, if you look at Aircom, if you look at the banks.
Absolutely. I couldn't agree more. So every day we talk about this. Every single person that rings us wants to know, what is an easy way to get their money out of the banks, earning for them. They see inflation rates, at higher than they've been in 10, 15 years. So people are edgy, and I think they know they should be doing something. They just don't know what it is. And then when they hear the rate, they go, what's the point if I'm going to lose most of my gain anyway? Why would I bother? So it would open the floodgates. I'll tell you what it would do is the floodgates would open in marketing of new products and new opportunities. The product providers will be all over it. And then it'll be a case of trying to figure out, can you access these new favorable rates and not get fleeced and fees and charges and other stuff? So I think it might take a little bit of time for people to get comfortable with it, and the timing might be horrific, or it could be brilliant. If Trump's news tonight really damages the markets, the timing could be great, but just unfortunately,
to clarify, sorry, we're recording this on Liberation Day, as it's called. So this podcast might come out a bit later. So just in case.
So if the current markets are, volatility increases and there's a correction in the first half of 2025, then maybe the timing of launching, what more widespread appeal or, attractive investment propositions might be perfect. I'd be terrified that this gets launched and everyone gets very enthusiastic about now investing into ETFs, and then we have a big correction and more damage is done, because people still think very short term when it comes to investing. So, something's going to happen. I just can't tell what the exact detail is going to be, but it's going to become more attractive than it is now, for sure.
Okay. Yeah, you're right about the timing. It's so counterintuitive, and I said this a bunch of times. The worst time it feels to invest is usually the best time when you zoom out. Do you know what I mean? Like, as in when you're kind of edgy about everything is probably the time you want to be putting money in. And when it feels the easiest to put money in, when you're seeing a bunch of green days over and over again, is likely,
well, we did
opposite.
It really is. We do kind of these quarterly client lunches where we get clients in just to talk through topical issues. We rarely do a lot on the investment markets, but we did this time just because markets are particularly volatile. And I showed people in the period 2002 to 2022 the S&P 500 returns if they had missed the best 10 days.
Yes.
That's it's an obvious kind of comment. It was less than half the return of just being in the whole time. But what really fascinated people was the two best days in that period were both in October 2008. I think it was the 8th and the 13th of October were the two best days in that 10-year period. If you'd missed those 2 days, your returns were severely damaged, because I think they were both, one was 11% and one was 10% in a day. So that's the challenge, as you say there, with trying to get in when things are red and the news is at its worst is very difficult for people. So
Yeah. So what we say, the easiest thing to do is just do it at the same time every month and don't
yeah,
even worry about it. And
yeah,
that's why it's kind of sad that the passive investing option isn't really there for Irish investors, because that's when
yeah.
it's so easy to do, when you don't even need to
Agreed.
look at it.
Yes.
Okay, we're going to move on from Ireland now, because I know we have a lot of other listeners on the podcast, but I just want to ask one more question. Why, in your opinion, are Irish investors or the Irish public so focused on property? Is it just because there aren't other options there, or is there something more kind of long term behind it?
It's a long term educational piece, in that we've seen previous people get wealthy buying investment properties and big gains, uh, and and people will be influenced by what they've seen has worked in the past. Typically, that's always the case with investing and property. Anybody who invested in property in the 90s in Ireland did extremely well, or anywhere, any big city in the world, became multimillionaires. And if it was leveraged property investment, they became extremely wealthy. So there's that aspect to it. But I think more importantly, it's easy to understand. It doesn't feel volatile. The key to
Mm,
property investment, the one single reason why it's so attractive, is because it's hardly ever valued.
yeah,
Uh,
it's
it's
like
not
it's like
valued.
private equity investments.
Yeah, it's not valued every 5 minutes, and you can't go onto your phone and check the current value of your apartment in Clongriffin or whatever.
Yeah,
It gets valued every time something sells on the property price register, so maybe a couple of times a year, and so there's no volatility, or very little. And and in the meantime, you have this lovely rent coming in every month, which is uh, and you can drive by it and have a look at it and see it's still there. So
it's tangible. Yeah,
in theory, it seems really attractive, because it doesn't jump around the way equities do, and you get a lovely income. In practice, it's completely different to that, of course, but uh, that's why it's so attractive and remains attractive now. And I suppose the first point being the education piece and what people have seen in the past. The second is that perceived lack of volatility and stability. But the third piece then as well is everyone is absolutely desperate to get on the property ladder, and we have a massive housing crisis, so there's a shortage, and people see that as being a good investment. So you add the three of those together, and it's very compelling. And if you do it, like I don't know if you are, but I'm bombarded in my inbox by pension property promoters, and if you can do it in your pension, it seems even more attractive again. So it's non-stop bombardment of that compelling story. And all we
yeah.
hear in the stock market is that Donald Trump or someone else is causing awful trouble, and it's volatile and it's about to crash. So I don't blame them in a way.
Yeah, there's a lot less noise.
Yeah.
But yeah, no, it's a good take, and I appreciate that. Okay, let's move on to some more kind of general advice. So, as a financial planner, what would be the one piece of advice you'd give to someone, say, just out of college, just started their salaried career, who
Yeah.
want to start out on their investment journey? Okay, folks, if you've been following this podcast for a while, then you'll definitely have heard us talk about Horizon. It's our premium product. It's our most comprehensive stock investing service we offer. You're going to follow Emmet and all of his experience over 25 years in the market plus, and invest in the stocks that he believes will be absolute world beaters over the next 10 years and beyond. There are stocks in the Horizon portfolio right now that are going to be tomorrow's massive winners, but there's actually one in particular that Emmet has bought for a fourth time in the past 12 months, which is very out of the ordinary for him. So there's a lot of conviction there, and he just can't stop talking about it, really. So I say all of this because if you have been debating joining Horizon, if you've been listening for a while, we have a very special offer for podcast listeners. It's going to be 50% off until Easter Monday. From Thursday to Monday, you're going to have the chance to get into Horizon for 50% off. If you've been humming and hawing about this decision, now is the time to act. And that's everything. Okay, back to the interview with Dave.
We love to start even earlier with people if we can, but uh, I tell people to try and set up it doesn't matter how small it is, a tiny direct debit into something that's invested in the markets, and get into the habit of consistent, regular savings. Uh, uh, Ideally, it's in a pension in Ireland at the moment in the tax structure, but you need to have some liquidity. You need to have some availability to cash. So if you can just get into the discipline of having something automatically coming out of your bank account every month at pay time on payday into something productive, not into a credit union account, not into something that's cash based. That's something that is invested, and ideally, if you have access to that all the time, that's more powerful. And that's the start. And if we have parents coming to us with, maybe putting a little bit of money away for their kids, the children's allowance or something, we love to start it even earlier and give the kids, if it's very young, give the kids a little bit of access to trade a bit. Pick a couple of stocks. We'll sit down with them and say, what companies do you like? What brands do you like, and get them educated on the markets. I wouldn't ever let them invest the whole pot. Now, it might only be $1,000 or two, but it's
Yeah. You have a 10-year-old coming up to you with nuclear or refinery companies now. And
you'd be
like
amazed. We had one 13-year-old who wanted to know, could she buy a pony with the with her savings account. So, but it's if they don't get that in school. So in their teens, we love doing a little bit of that education just to get them used to the markets when it's small, so that by the time they get a decent amount of savings in their name, they've learned some lessons and they can discipline. So when you get into your 20s, then it's about balancing that regular savings habit between starting a pension and having some money yourself that you can access for longer term housing needs or whatever. But just start small. It doesn't matter. Don't worry if it's 50 quid a month going into Revolut and you're investing into an indexed global equity fund. It's a great start. And the compounding over the long term is really powerful. By the time you hit 40, the growth on your investment portfolio will probably be as much as your monthly contributions. And you get that double compounding effect, and it's very effective. And I wrote a piece recently about advice I'd give to my 26-year-old self, and one of the parts to that was just to stop frittering money away on stupid things. That's not. I don't mean budgeting around whether you buy a cappuccino or not, but it's just if you have that money coming out of your pay every month before you get access to it in your current account, then it just gets that money away from a spending habit, which we all have. If it's in the bank account, we'll spend it. That's the way it works. So try and get it out before you see it.
Yeah, absolutely. And you almost introduce your opportunity cost as well. Do you know, if you're going spending 200 quid on a concert ticket or something like that, oh well, like as in if I don't have that, if that's already gone to my investment account, then it's not accessible.
Yeah. Now, and I do like to see the investment account being. I don't like early encashment penalties and these 5-year lock-in periods and things, but I do like it to be slightly removed, because if it's just on your phone and you can swipe it back into your current account in a blink of an eye, it's a little too easy to access it. Just if it can be just one step removed, that it might take you a day to get it. It stops the impulse spend as well.
Yeah. You wouldn't going on to trading 212 on when you're in the pub short for a round.
No.
So we'll say some form of direct debit or automatic contribution would be like that number one investing habit you recommend. What would be the number one pitfall you try to avoid or get your clients to try to avoid?
I try to get them to avoid picking stocks themselves and chasing the latest get-rich-quick scheme, because a lot of people in their late 20s, early 30s are desperate to accumulate some wealth, mostly for housing. And I totally get that. It's absolutely understandable. So they're going to chase crypto and they're going to chase meme stocks, and they should be listening to MyWallSt and having a disciplined investment approach, or just invest into index funds. The big pitfall for me is poor discipline when it comes to investing and chasing whatever get rich quick scheme is out there at the moment. And in the vast majority of cases, it just causes awful damage.
Yeah,
you do get the odd story of someone who gets lucky and times it beautifully, and they'll influence everyone else. But unless you have a disciplined financial plan and investment plan, it's mostly gambling. So that's the big pitfall, is unguided get rich quick schemes.
Yeah, well, that's my concern, is that I think people are molded by their introduction to financial markets more than they realize. So if you started investing in 2010, I imagine you're going to have a very heavy tech forward
Mm.
portfolio. Do you know what I mean? And you're doing
Yeah,
incredibly well. You've had 14, 15-year bull market essentially,
yeah,
more or less uninterrupted. If you came on, and what an awful lot of people have come on is in 2020 around COVID, when they
mm.
had a lot of extra money and a lot of free
Yeah,
time, that was a very different market. Okay, you did well, but in a gambling terms, like as in you had the meme stock rally, you had crypto, you
mm.
had what you're calling get rich quick schemes.
Yeah,
And I fear that, like, for someone who's 24 or 25, their view of the stock market won't be this long-term wealth creation machine. It will be a get rich quick scheme where, oh yeah, we'll do 100 naked option calls on
yeah,
GameStop tomorrow because
yeah,
someone on Reddit said so. And
yeah.
and and that's what I fear, is that will the will the long term benefits of the stock market be lost on certain people?
Yeah, and it's not just though like that. There, that's the really obvious, you know, group of people that might show poor discipline. But I also come across every day an awful lot of people who've generated a fair bit of wealth in stock options, working in the tech companies. They might be just a little bit older. We're probably talking people in their 30s now, and they've had Google shares, or they've had, whoever, or even in the pharma sector, stock prices have done very well in the last 10 years, and they've generated, so in some cases, hundreds of thousands or millions of euros worth of stock options, and they haven't learned any investment discipline to have that size portfolio. It's just happened in their careers, and
Yes, that's very true.
they don't they don't diversify. They keep the stock because they believe in management, and it's worked for them up to now. And it's very hard to get them to sell out and diversify into a broader portfolio. And we see that with Intel and Workday employees last year, where they got, really badly damaged by being over concentrated.
Yeah,
So
Facebook the year, what, 2 years
so
before?
many
Yeah.
so many stories. Even Volkswagen, which would have been seen as being really stable when they had the emissions scandal. So there's always a company can always get in trouble. Any single stock, as you guys know, can get in trouble. So that's a pitfall, as well as holding too much in your employer's company, or company stock. And they got rich quick by doing it, and now it's
Yeah.
time to be disciplined and manage risk.
Yeah, it's a good point, but I think it was Warren Buffett famously made Bill Gates diversify out of his Microsoft shares in the 90s or 2000s. He would have been
Yeah,
the richest man in
yeah,
the world 3 times over today if he never sold. But
yeah.
it's
But for
true,
every one of those, there's 10
yeah,
of the opposite.
absolutely, it's the exception that proves the rule. But
Yeah,
it's true. It's another cohort of investors in Ireland that aren't really, they're investors without being investors, is what you said. They're
yeah,
kind of,
yeah,
they could have a portfolio worth millions that they don't really realize is a stock portfolio. It's just, oh, this is part of my work
yeah,
benefit. You know what I mean?
yeah,
So that's a really good point. And I imagine it would be quite a fruitful, if you're a financial planner, quite a fruitful market to target,
yeah.
because there are these people that have amassed incredible amounts of wealth, but still aren't educated enough to manage it properly. Would that be fair?
Very much so. Yeah, yeah. And they come to us with concerns around continued career and financial security for their children, or trading up a house. And we say to them, well, the biggest risk you have is that both your future human capital and your future wealth is all
Yes,
relying
yes.
on Google or whoever. So you're all in, and they don't see it that way until we show them what could happen in a Great Depression style problem. And yeah, it's
Yeah.
a big wake up call. But it's great. We love those conversations. That's why people come to us, is to give them the steer. That they
Yeah.
need some guidance, because we get so emotional about money, and we get so connected to our own position, and we can't see the wood from the trees most of the time. We're busy bringing kids to GA matches. We don't have time to sit down with our spouse or our partner or whatever and think about our plans and what should we be doing here. And if we
Yeah.
do, we go into Reddit and then we get really terribly scared and confused. So, yeah.
Yeah, it's not the place you want to go to with doubts, I don't think.
No.
Okay, I'm going to ask you one more question, and we're going to call it quits here. Another broad one for you, but I know you're able for it now. How would you describe the differences between wealth creation and wealth preservation? And you've seen it within your financial planning experience, and
Yeah.
how do they differ? How do the strategies differ?
I actually, most of the time, in my view, and I'd be kind of somewhat controversial in this, is I think they're the same, really, in that wealth preservation has to have some growth, and there's no point in leaving the money in the bank to really preserve it and protect it because inflation destroys it. Uh, so wealth creation, like the first thing I say to people who come to me when they ask about creating wealth in Ireland, the best way to create wealth in Ireland is to set up your own company and be your own boss in a business. You get hopefully quite high growth rates if you're good at what you do, very tax efficiently with full control over how you manage that. So that is the first strategy I would say to someone in their 20s, if they want to really properly create wealth in Ireland, is to be your own boss, have your own business. You've so much control and there's so many incentives to do it. But not everyone is in a position to set up their own business. They just mightn't have the idea, or they might be brave enough to do it. So after that, then it's about trying to be brave enough to have a decent portion of equities in your portfolio as you grow and as you save and earn money and put money away, either in pensions or in savings. We're afraid of equities because they're very volatile short term, but they are other than owning your own business, they are the best generator of long term wealth, and that's why Warren Buffett is as rich as he is. And anyone who has created a lot of wealth has either had an equity portfolio or had their own company, which is just one equity.
Yeah, or
um,
or
uh,
inherited. That's the
or
third.
okay, or inherited. Fair point. Yeah,
That's
yeah,
tough.
but
That's tough to give someone advice though, to go get some inheritance money somewhere.
yeah. Well, you could marry well, I guess.
Get a nice dowry.
Yeah, that's in meeting two of our financial planning process, is how to marry well. Wealth preservation then is very topical, particularly for older people who are approaching retirement and they might have a decent pension fund and they're worried about it running out. And I've been to a lot of conferences and studies. Bill Bengen is famously kind of founded the 4% rule on how much you can draw from a portfolio sustainably. But all of those sustainable drawdown, kind of wealth preservation strategies still involve a lot of equities. You can't do it and leave it in the bank because you're drawing from capital, and inflation is, silently drawing from capital as well. So wealth preservation can't just be cash and bonds and security and safety and that comfort blanket that comes with that, which short term makes people feel really good. And they can sleep at night, but long term, it just destroys wealth. So we would still be overweight equities with people's portfolios relative to kind of the default pension strategy pre and post. So for preservation and creation, we'd like to see lots of equities, but it needs a lot of discipline to do it right, and not let our emotions get in the way. So when it comes to the only part of capital preservation that we would stick to is we would like to, generally, for people when they've built a bit of wealth, to have a year or two of income in something reasonably secure, so that if we do have a bad market correction, they're not a forced seller of equities. That's what we would try to avoid in the later years of the wealth journey. In the early years, we don't really care because they're starting out and it's accumulating as much as we possibly can and benefiting from compounding. Later on, there does need to be a little bit of a buffer.
Okay. Okay. Good man. Okay, Dave, it was great to have you on. If you want to tell everyone where they can find you, tell any more plugs you can get in for Investwise while you're still on the podcast, you're now welcome to.
Okay, thanks. Yeah, well, look, I've described our process. If anyone wants to find out a bit more, investwise.ie is our website. And I talk a lot about what we do on LinkedIn. So if anyone wants to look me up, Dave Quinn on LinkedIn, or reach out to me, and I'm always happy to help and give people an initial steer anyway, even if they don't want to necessarily engage. I can promise we won't be selling anything. We'll just be giving advice.
Good man. Okay, Dave, thanks a million for joining me, and thanks everyone for listening in. We're going to talk to you next week.